Gareth Lewis-Davies is an oil market strategist at BNP Paribas, joins us live now from the bank's London offices. And the oil price seems to have been correcting itself for the last few months. What is driving this price action now?
Well, in essence, there's a combination of supply-demand fundamentals and what's going to happen to inventories, and also elements around financials in terms of the policy easing that the various governments are undertaking to encourage economic development. And the two elements are both supportive over the second half of the year. And although oil prices are treading water over the last day or so, we nonetheless feel that oil prices will move on from here, and it's particularly strong in the fourth quarter of this year.
And Gareth, we've seen that the central bank in China moving to reduce borrowing costs for their economy as well. Is that going to be a positive thing for oil, or does it actually signal that China and perhaps even other emerging markets are at risk, or at least are not immune to any slowdown in the developed world?
China is a very important element in the demand story for oil this year. It's our view that China's economy will have a soft landing rather than a hard landing. But a number of government initiatives will be required to ease this soft landing, and we believe that further moves will take place later this year. And in doing so, this will sort of safeguard our oil demand assumption for China. And overall, collectively, globally, the oil demand is set to grow more strongly than non-OPEC supply over the remainder of the year. As a consequence, the requirement to rely on OPEC will increase. And that is one of the key reasons why we feel oil prices will edge higher.
So does this mean going forward there's going to be less uncertainty in the second half of this year? Do you see demand holding well enough to offset any supply-side constraints?
Yes, I think although many are focused on the demand side of this, where there's the greatest risk, I would suggest, is on the supply side of the equation. We have had a number of outages at non-OPEC areas such as Yemen, Syria and Sudan. And they've sort of offset good news, shall we say, in terms of increased production from Libya and Iraq. But where the key uncertainty is the extent to which Saudi Arabia is willing and able to replace the Iranian barrels that are off the market as a consequence of the embargo.
Gareth, why isn't it a given that Saudi Arabia will simply export more crude to make up for the loss of Iranian oil?
Well, at the moment they're producing at record levels, which were last achieved way back in 1980. In theory, there is an assumption of a spare productive capacity residing within Saudi Arabia, around about 1.9 million barrels a day. Until it's tested, we'll never know whether that spare capacity actually exists. It is our view that it does exist, and Saudi Arabia will be able to provide enough oil to the market. But in doing so, it will be doing it at the expense of spare productive capacity, globally, which we feel will fall to levels last seen in 2008, around about 1.4 to 1.6 million barrels a day globally. And given the enhanced geopolitical risks not affecting just Iran but all around the world, a spare capacity of that level is low, given the inability, therefore, to supply oil if there's an additional unforeseen supply outage. And as a consequence, that would also lead to upward price pressure on the oil price.
Okay, but on the other side of the equation, despite what you've just said, you have ongoing uncertainty here in Europe. You have what we're watching today, the US jobs report. Yes, we're expecting an increase, but it's nothing near the sort of 150 to 200,000 level, which we need to see to make a significant difference to the overall rate of unemployment in the US, which is the thing that we watch. Do you not think that weakening growth in the developed world could ultimately outweigh those supply-side risks that you describe?
Certainly, demand growth assumption that we have at BNP is 1 million barrels a day of incremental demand in 2012. Most of this happening in the developing world, so therefore the developed world is less relevant. I think what we're seeing in the developed world is scope for further monetary easing, for example, in the United States. And in doing so, that would increase money supply, and it would in effect lead to a weakening of the dollar, which conversely would lead to a strengthening of commodity prices, including oil. Now, what we're seeing today in the data releases that will take place, non-farm payrolls and unemployment, counterintuitively, if the numbers come in worse than expected, that will increase the expectation of further monetary easing happening sooner rather than later, and that will boost oil prices. So although at one level you might think that will be numbers coming low will be bad for oil demand, nonetheless, if it brings forward quantitative easing, a weakening of the dollar, that will feed through into higher oil prices.